we're going to have Jerry Wamsley, did I say it correctly?
Yes, perfect.
He's going to be talking about borrowing money for today's investor and the smartest ways to get the money. So let's give Jerry a warm welcome.
First and foremost, this is a self-directed IRA handbook for those of you that do have an IRA or you're just wanting to learn more about them. I'm going to give this through a drawing. So I'm going to go around and my lovely assistant here, who's also my wife, is going to collect any contact information, and we'll just have a fair drawing and then whoever gets to get it. But it's a really good read. I read it. I suggest that everybody reads it. But I'm just wanting to share that with you. So it's here for whoever. My name is Jerry Wamsley. I've been in the banking, broker, mortgage industry since 1997. Pretty much been here for basically 18 years experience. I've been nationally recognized for both quality of work and leadership and production through a lot of large lenders that used to be around as well as are still around. I do specialize recently in real estate investment and rehab financing. Rehab financing is definitely something that's been needed. As you can tell, our inventory is in disrepair. A lot of it needs to be brought up to current standards. So I do have access to those programs as well as even the more aggressive programs from the investment side. I do have in-depth knowledge of the industry secrets of basically Fannie, Freddie, how to use what to use, and basically how to make the right move so you can get at the end game. Getting the right mortgage for the first time, that's the most important. I'm not one of these guys, and I strongly believe in conditioning. You just can't jump into something. You jump into it, then you incur additional expenses. So basically, what I mean by that is you get the mortgage for the first time, you don't add $2,000 to $4,000 each time you refinance the transaction. Eventually, you got a mortgage balance up here, and the property value hasn't appreciated with that. So, personal. I truly do care about my clients. Most of mine is referrals and repeat business. That's just how it is. If I've ever worked for anybody in here, some of you I've talked with and met, it's one of those things that even if I can't help you or I can't give you some direction, if I can't help you or I know somebody that can't help you, I definitely refer you to them. So that's pretty important. That's what we should do as a real estate investor and partner. I'm a federally licensed mortgage banker. That means I can do loans in all 50 states. I'm primarily regulated by FDIC in that capacity. I'm also a licensed real estate agent. I do have a license in the state of Ohio. I'm a member of JerryWamsley, I'm a member of Corey, I'm in Columbus. I have been on this training. I needed to understand this with you guys and see how you think. So my wife and I are also members and investors, but I took some of these classes that our RIA offers, and I suggest that you pretty much get into your RIA and know what you can and can't do. Sorry about that. What you can and cannot do, and just educate yourself, because just having a little bit of education instead of knowing the full plan can get you in trouble. So take your classes that your RIA suggests, and absorb it all and try to put an application. All right, this is my disclaimer. This is just a conversation. This is us talking. This is us basically sitting here and talking about agency lending. We're not going to go into particular personal qualifications. We're just going to talk, so this is just advice. This is through my personal experiences, anything that I've encountered, anything I've seen, anything that I've got to experience. So, there's my disclaimer. It's right there. Do not take this as lending advice because I haven't looked at your credit, capacity, etc. Please hold your questions until the end of the presentation. I've been in some of these weekend seminars where there's one guy in the room that just asks a series of questions, and it's not fair for everybody else. So if we just sort of wait until that moment allows itself or organically happens, it'd probably be best for us as a group. So that being said, show me the money. There we go. All right. How can today's investor borrow more money? The government's tightening up. The standards are tightening up. They're actually getting a little looser. This is just recent developments. However, when it comes to lending, the standards, the regulations, and the correction of real estate values, everybody's scared. There's a lot of money lost. So they tighten up their lending standards, and what's that resulted in is basically they're looking at you. They went from looking at you with a telescope to a magnifying glass to a microscope in some cases. They're really looking at you. So basically, I'm going to help you determine which agency, which ways to borrow that, look at that. Show me your vitals. Basically, are you an entity? Are you a human being? That's how they look at things. Are you an entity? Are you a human being? Human beings, and you're basically being involved in not an entity, there's a lot more laws that apply there. So Ohio is very, very stringent on that. I mean, they really protect people that live in Ohio, and they'd rather see an entity, because then you should know better. Train yourself to better yourself. Analyzing qualifications for each loan, we'll also discuss that. Understanding the fundamentals of all lending. That being said, it just sort of basically what I'm trying to do here is educate you and give you some ground rules on what lending does and how they look at things. Lending's the same, whether it's commercial, whether it's primary residential, whether it's investment, they look at the same things in each category. First of all, cash. How much cash do you have in a transaction? So it's cash, credit, collateral, capacity, we'll cover each one. How much cash do you have in this transaction? Basically, if you're buying a house, what are you putting down? Okay, after you put that down, how much money do you have? What's remaining? Do we have reserves? An interesting thing about cash after closing is reserves. In agency lending, Freddie Mac, Fannie Mae, if you have, after closing, and you have a 660 credit score to 680, they require 12 months of reserves of that mortgage payment, plus 2 to 3 months of whatever other properties you're holding. So that's just one example. Considering that, cash, how much you have in a transaction, how much do you have after the transaction, is definitely something to consider. The next thing is credit, your past performance. When you are granted credit, how did you perform on that? Primarily in the last year, more than likely they're going to look at the last 2 years. Those two things determine not only your credit score, but basically how they lend. You can actually have lates on your mortgage if it's a primary residence and still refinance in current agency guidelines. People don't know that. They think they have a late and they can't do nothing. Believe it or not, you can. Sorry about that. And then we have collateral condition of the property that could range from walk-in, turnkey, everything's great. There's no risk there. The bank doesn't have to worry about you defaulting on a loan because you turned around and put a ton of carpet in there. A ton of carpet, paint, thing. Next thing you know, your savings is depleted, your credit cards are maxed out, and you're exhausted. You are now at capacity in the credit situation. You utilized it wrongly. So that's important too when making that decision. Of course, and what's the current value versus the proposed or after improved value. So those are another thing. So basically, again, these four are the most important of any lending. Going to buy a car, going to do commercial property, going to get an SBA loan. They're going to look at all this, all right? Capacity. How much do you have? How much income do you have? And what is your ability to repay? So basically, in a lot of cases, especially agency lending, they look at that. They have to. It's called QM. It's qualified mortgage. If you do not meet certain capacity requirements, and we'll elaborate on that some other time, but it's pretty serious stuff. It's Dodd-Frank, pretty serious stuff. The repercussions of not following and qualifying somebody and looking at capacity. If they can even afford this loan, this land contract, this lease option, or whatever you design to set them up with, it's very important to make sure they qualify as a qualified mortgage. That's the federal law. So you might want to read into that, do your own research. Risk layering. 4 C's, look at it collectively. They're all pillars of this room. If you have one weak pillar, that's fine. You give me 2, it's probably going to fall apart. So looking again at the 4 C's, cash, capacity, credit, and collateral, looking at each one of those, one is okay to be weak, you give me 2, then it's going to fall apart. However, I'm the type of person that I'll teach you how to strengthen the one and shore it up. Let's shore it up. The timing's good. Let's work on this. If this was me, this is what I would do. Position you as a member of the RIAs. You have a depth of people here that want to help you. They want to help you win. So, dig into this group around you, pull it out of their brain, take advantage of it, and then put it in application. Money sources. Let's talk about money. That's why everybody's here. This is from personal experience, researching, doing things. I went out and researched to find products for this environment, for this community. There's a lot of people that approach me and say, Jerry, I need this. This is what I'm trying to do. This is what I'm trying to do. So I went out and pretty much got a buffet of lending options, whether it be agency all the way down to high-risk lending. But, it's lending. That's what's mattering. That's what matters, excuse me. Property type, of course, determines risk, primary residence. You're more apt, and this is why if you look at agency financing, your primary residence sources are VA, USD, FHA, 203K, as well as conventional. On an investment property side, you're going conventional, which is Fannie and Freddie in the home style. And then we do have additional sources that I don't have up here, but those will be on a case-by-case basis. But that's agency financing. This is pretty much the bread and butter of lending these days, whether it's primary or investment, and then of course we've got other sources. You have SEDIRAs, basically self-directed IRAs. You have owner financing of the person that actually owns the property now. There's actually hybrids out there. A lot of lenders want to see an LLC. They want to see an LLC. They want to, basically that way Dodd-Frank goes out the window. So basically that's the benefit of an LLC. Dodd-Frank does not apply to that. All right, so that's why in Ohio's got some pretty sharp teeth on this basically protecting our constituents. So that's why in Ohio, and I've heard this repeatedly, LLC financing only. There is one case to where they will look at your personal tax returns, and if you have something on your Schedule E that show that you have real estate experience, they will take that into consideration. So those are out there for you if you don't have that LLC set up and you're just in a growth period. Entities, you know how to set them up. If you don't, get with a senior member of your REIA, maybe they can help you out. There's plenty of sources that can do that. Consult your professional. But you got your C Corp, your LLC, LLP, and then of course as far as non-recourse, basically there's a personal non-recourse there when I was talking about. They'll just go after the entity. You don't personally guarantee anything. So these are the little important things as you're borrowing money to be aware of, and you find in your sources. Non-only occupied financing. First of all, let me bring up Fannie Mae Homestyle. This is a misprint on the cartridge. It says 95% of the after rehab value. That's for a primary residence. So if you want to borrow up to $417,000, I can actually, if you find something, finance up to 95% of the after rehab value through Fannie Mae on their Homestyle product. All right, so that's based on what the appraiser says, not what your acquisition cost plus improvement. So if you borrow 95% of the after improved value and it appraises for more, then of course it's subject to what the appraiser determines and not the actual lower amount. You close without hassles. I close loans all day without utilities being turned on. There's a rumor that goes around it. You can't do that. I don't have a problem with it. The secret around it is just you need to make sure you get your group of professionals, which are plumbers, licensed HVAC technicians, electrical, and any other systems that are around there. And then you don't even have to turn them on. So get them licensed, insured, to a certain letter that requires that needs to have a certain verbiage, and you can get those done. When you don't use the funds for this particular loan, okay, let me answer this real quick. 95% for primary, 85% for rehab investment. So Fannie Mae will allow you to go up to 85% on an after rehab value using licensed contractors, not your own. You can't be your own contractor. You have to be licensed professionals only. And 85%, that's down to a 660 credit score. So I don't know if you picked that up or want to write that down. That's pretty critical there. The thing is about utilities, when you don't have them on, there is a 15 to 20% contingency reserve for those licensed individuals and their quotes, and that's a what if or contingency fund should they run into termites or any unforeseen things that need to protect you and the lender and make sure you don't run out of money. Any unused funds is applied to the principal, or you can create any scope of work and add that to, basically the job you're doing. But if you don't use it, it's going to get resent back towards your principal. But that's a good way to get into some of these rehabs. It really is. It's a sweet product, especially. My suggestion is a buy and hold on this product. But again, based on the after rehab value of the appraiser, not what you determine. And the appraiser, they like the nice countertops and all the additions, the features, and et cetera. So for example, even if, let me just give a quick example here. If you buy a house and it's 95%, I've been that guy before. It's 95% and the house appraises actually in that now the loan balance is 80% of what the house is valued at by the appraiser, you now no longer have mortgage insurance even. So even though you went in and you thought it was doing that and you added a few additional features, even though you think that it might be 95 and appraises over that and it puts you into that 80%, you will not even have mortgage insurance on that loan, which is unheard of. It's unheard of. It's a hard product to compete against. All right. Close without the hassle of turning on utilities. That's so important. I mean, these banks, they won't turn them on. From my experience, and I do a lot of lending rehab for my clients, they won't turn them on. I'm like, that's fine. As long as you know we're going to collect a contingency reserve, we can move forward, and it puts everybody at ease. And it allows that person that nudge themselves in there and make something happen. You know, it's just, again, it's unheard of. Short-term fix and flip. We do have commercial lending available, commercial financing. You can finance short-term fix and flips. These are termed as bridge loans. So basically you're acquiring, you're going to rehab, and as you rehab, you're going to turn around and flip that, or you're going to even put it into a rental portfolio. It's your choice. But I do have that lending available. It's determined. So this is unfortunately, this is the only thing I don't like about it, is you are going to incur 2 closings. Okay? So you want to make sure that you got a good margin there on those things. LLC investment properties, buy and hold programs, you know, they're all available. Stated income. This is back only through an LLC. You're not going to get this on any type of personal lending. It's going to be strictly an entity. I can't do it just because of Ohio laws, but there is a stated program that's actually going to look at your income. Terrifying. You know, we can go over that if you want to call me or discuss that, or you know, we can go over other questions. And it just came out today. I was on a conference call before I came here, so it's that cutting edge. All right. Position yourself to sell. Buy to retail, max seller contributions. If you are going to come in as an investor and you're buying it in an investment capacity, 2% is the agency guideline. So on agency financing conventional, it's always 2%. That 2% helps out a lot when you're going to closing, and whatever you're buying, you're getting 2% credit on your closing costs, because people don't realize on investment financing, in the agency side, it's 15% plus any closing costs and prepaids as you're bringing to closing. So that can add up pretty quick. 2% is important to ask for. So don't be afraid to ask for it on your purchase contracts. Offer creative financing. There are some of the commercial lenders dropping back out of agency into commercial. This is very confusing. There's a lot of differences I'm talking about. If you drop out of agency financing, which is the mainstream of Fannie, Freddie, FHA, USD, etc., that's out of the agency, you go back into commercial, you can do carrybacks, which haven't been heard of for a while, but they're out there. You know, you just got to do it. You're typically limited to 10%. Typically those are allowed on commercial, again, commercial entities. So it will be, you'll see like a 75 and a 10. So you'll see up to 85%, which again, cash, you're bringing a 15% to closing, whatever, plus any closing costs. Okay, so keep that in mind. It's really critical. See your real estate agent or whoever you're working with to help you structure that financing and make sure that they tell you to bring 15%. People bring 15% to closing, and they think that's all I got to bring, and then they get hit with the 4,000 in closing costs or whatever, and it's sort of a shocker to them sometimes. So make sure you know up front what you're getting into. Let's see. Separate your house from the competition. You know, most people, when they buy your houses, if you're buying and rehabbing, they want to know how much do I need for cash for closing, and what's my payment? And then what everybody wants to know, how much do I need, and what's my payment? So separate yourself from your competition by saying, okay, I don't mind paying a little bit of closing costs for the buyer. I'm going to give them, you know, say the qualified rate today is 4.25. I'm going to give them 3.75. I don't mind paying the lender a point, because that half a point on the interest rate is going to make that house seem more affordable, and the payment's going to be less. So that's one way to separate your house from the competition that's out there, and you're allowed to do that. You know, you own the property, you're allowed to give whatever incentive you want. Okay? Know the seasoning requirements. You know, I know other investors, and they get themselves in situations with FHA, which in the last 48 hours, I heard that no longer applies. It usually was 91-day seasoning on FHAs, 2 appraisals. I'm sure someone would run into that. Recently, I've heard, and I've communicated with my underwriter, there's a new FHA manual that's out, and they're not requiring that anymore, from what I've heard. So if you no longer have to stay on your FHA property, it just opens up a lot more qualified buyers on FHA to buy your flips a lot quicker. Or not flips, let's call them retails. I'm sorry, excuse my negative, it tells my age. All right, accurate holding cost estimates, another seasoning. Accurate holding cost estimates, you know, position yourself up front. Know how to go in on the buy by estimating those holding costs, because they can add up, especially if you get caught under a seasoning. You know, I mean, some people don't want to hold on to the property. Some people have a 6-week plan to exit. You know your seasoning requirements and get your holding costs accurate. All right, let's talk about some gift programs that are available for Ohio. We've got a 5%, up to 5% down payment. That is through Communities First. It's out of the Cincinnati Port Authority. That's interest rate changes daily. But if you have a property and they don't have a down payment, this is designed pretty much for the guy that rents, pays his rent on time, but just can't ever accumulate that down payment. It allows them to go up a personal income of $70,000, sorry, around $72,000. So it's not household income, it's whoever's on the application. So that's pretty important again. You can get up to 5%. They have a 3% program. This is a conventional product as well as FHA and VA and USDA. And in some cases, they will allow 203Ks, but I won't do them. So there is a 203K program, and that's actually, US Bank has a servicing contract with the state. So me as a lender, we originate them, and then US Bank has a servicing contract on them. There is a 1% origination and a processing fee. So a lot of times if they say I don't have enough money down as an investor, if I was selling this, I'd be like, well, you need to get down payment assistance. You know, I'm not gonna pay 6% of your costs. I can pay 2 or 3. You need to go here and get this, because I'm not gonna pay that. You now have that ability to make sure they know that. You know, 2 and 3% adds up. Increased. All right. Hopefully we're on schedule, not above schedule. I didn't start my timer. But do you have any questions? I'm up here. You know, any questions?
Hey, Jerry, I'm a collector.
Oh, let's get the cards while we're doing the questions, if you don't mind. Again, and for those of you that walked in late, we're offering as a, you know, as an incentive for me to get your name and information so I can spam you and send you all this mail that you don't want.
You're already spamming, Jerry.
This self-directed IRA handbook. It's a good read. It teaches you cases of what to do and what not to do and how to be careful. I suggest that if you are doing this, you know, I took a 2-day seminar with John Heyer, and it's terrifying of how you can make that a bad situation, and they can basically explode that thing and you can pay your taxes on it. So it's right here. Got to give me your name though, you don't get it.
Where's your card?
My cards, they're up here on the front desk. I'm sorry.
Okay.
Question? Yes.
You had said before that we could get loans from LLC.
I haven't
Yes.
gotten my card.
What about the land trust?
Where's your card at?
I would think that if the land trust has the ability and shows an income or whatever, or maybe not even income, you know, I would think that if it had the cash and assets, I wouldn't be afraid to pitch that to an investor if that's what you're asking me. There's nothing I'm not afraid. I'm not afraid to show anything that makes sense.
Now, if that LLC, if the land trust is in an LLC, how does that all?
What was that again?
If the land trust is in an LLC,
Or behind it? Yeah, you'd put that behind it to protect the land trust. So you'd probably put your land trust behind the LLC, right?
Yes.
The LLC has its own books, right? Probably. Yeah, as long as I'm sure the LLC made sense, I'm sure that they would look at that. Any other questions? Well, this will be
If you
easy.
don't have a list card, you just want to jot your name and number down.
Yeah, we'll take pieces of paper, as long as it's the right information.
Did you say the 90-day hold period was gone, or?
I heard that yesterday. I was shocked, and it's not. And the guy that gave it to me is a guy that's been doing this and owned his own mortgage company and sold it to Right Pat. So I mean, the guy is a verifiable source. So for him to say that, and his wife's my mold remediation specialist, I mean, I trust that information. But I've also asked my underwriter in that same 24-hour period whether or not that's true, and could I see it in writing?
Yeah,
That's
if
huge.
it is, let us know and we'll get it out to the membership. Yeah, exactly.
Just definitely.
Take your time.
Any other questions? Wow, this is easy. This is a lot easier.
I've heard, I've been seeing the word hybrid, what is that?
Hybrid? Hybrid is when you could, basically, you don't have an entity, but you do have real estate investment income on your Schedule E's to where you could show that you have a history. Typically, what they want to see on Fannie agency financing, basically agency financing, Fannie and Freddie being a part of that, they want to see a history that you know what you know what you're doing. Hybrid would be that for example. I just know in Ohio, I just got off the call, and they said that even personal financing was allowed on rentals, which I was shocked, but I need to clarify that before I can say, yeah, they will do that. What's your question? Do you have a direct question outside of that, or do you want to talk to me about it later?
You know what?
Hybrid's just a mixture. You don't have an entity, but you do have some real estate income. Does that make sense? and you want to borrow sort of personally and use your real estate experience and your current income from maybe a job or anything else you're doing to qualify. But you know how you hear service debt ratios and debt review? That, I just ran across the lender, as long as you have a 640, and these are for rentals. If you're looking, it's unlimited rentals. It's a minimum of $75,000 loan amount, up to $2 million. 25% down, they don't look at your assets. The credit score is 640, and it's got to be entity lending. That's just unheard of. So you don't have to shift assets.
You said 25% down
25% down or add equity.
or equity. Can you strap it to another property, the equity?
Blanket?
Yeah.
No, probably. They like single entities. That way they don't have to turn around and just dissolve a whole portfolio to get to a certain property.
Okay.
Said an LLC, Dodd-Frank isn't applying with LLCs, that even if they require the personal guarantee. Dealt with it.
Probably, I think from what I've read and what I've experienced is they don't even like the personal guarantee on there in some cases. Because it's sort of, you do get a favored interest rate with one of my lenders for personal guarantee in it, but in some cases I've seen it to where they don't even want that on there. Which is shared, because they're going to come after the property. You know, that's what they're going to find. Fine, we'll take the property because we underwrote it.
Okay, so let me understand your answer. What you said is you can apply as an LLC, they probably won't require personal guarantee.
Yes, they do non-recourse, personal recourse. Is that what you're asking?
Well, what I was asking, I mean, a lot of my experience banks will ask for a personal guarantee to loan you money. So I'm saying, okay, you said that they like to lend to LLCs because Dodd-Frank doesn't apply. And my question was, is Dodd-Frank not apply even if they require a personal guarantee?
That's a good question. You might want to write that one down. My experience and what I've talked to them about, they don't require a personal guarantee. They just want the corporate, a liable corporation or the entity, and then they want the property if you don't pay. So, but once you tie in that personal guarantee, I see what you're saying. Does Dodd-Frank protect you? And that's probably why they don't enforce that.
Dodd-Frank doesn't protect anything.
I know we can talk about that all day. I agree. It's sort of an attack on capitalism. I don't know.
So,
Yeah, right.
so, but I'm just curious because, just curious. That's the case.
Yeah, that's probably a Mr. Watson question who speaks on some podcasts if you don't listen. I mean, I would rather ask him. Or, I'm actually having lunch with a good real estate attorney that's next week, and I'll ask him too. Make sure we ask him.
Thank you.
Give his name so we get back to him.
Oh yeah, do we have your name?
I gave.
I'm not sure which card
my
yours
card.
Okay, I'm
You
sorry.
have to guess
Which
what it
card
is.
is yours?
Any other questions? Here's an idea. Do I have a little bit of time, or am I done?
Yeah.
Okay. Here's a thing that's probably creative for your family members. Anybody you care about. There's called a 203K, FHA 203K. And if I was to teach my kids or anybody else how to get ahead, I would use the FHA 203K because what it allows you to do is basically finance up to 110% of the after improved value. And I'm not saying that in a bad way to sit there and go, yeah, we want you to overmortgage the house, but I don't know many products that you can finance 110% of the after improved value and only put down 3.5% of the cost to acquire as well as the improvements. So you're basically putting 3.5% down, and then up to 110%, that's not always used. I mean, the cases that I've done in the last month, I'm seeing people doing these and they're walking in with $15,000 and $20,000 in equity right off the closing from the FHA appraiser. And I'm just like, wow. I mean, that's probably why in the last couple of months I've been more attracted to doing the 203Ks versus anything. I just love them. I mean, it's something to where it's what we were trying to do ourselves, but actually if you do it for your family members, friends, or people you care about, and you teach them how to do that, and you sort of coach them in as an investor, they're getting ahead. This younger generation has a lot of student debt. I mean, there's a lot of college students out there that are just buried in it. It's scary when I see it. And I see everything. I mean, outside of your doctor, probably an attorney that you were in a lawsuit with that needs to know everything. I mean, I see your bank statements, I talk to your employer, I look at your retirement assets, I mean, I see your tax return. I know, I talk to my wife about this sometimes, I'm like, I know so much about that individual that it's scary, and it's not a bad thing, but when you see that, and you see it in such volume, and you see a common denominator, you just want to help people. But I would say one product that can help people is the home style and the FHA 203K. And if you are a real estate agent or an investor or somebody that really cares about somebody, turn these kids onto this, especially if they have some debt and they can't get ahead, because it will get them ahead. And then make them go on a 15-year. They're going to develop equity. They're going to pay that thing down. They can turn around and sell that thing in 5 years, and then they're walking away with thousands of dollars to position themselves to what we don't have to do, and that's constantly work and grind and do what we have to do. Some of us. So exponential growth through generations. That's what we look for. Any other questions?
There is a Fannie Mae product that's designed for investors.
Okay.
What is that?
Fannie Mae Home Style is one.
It's like what we did, but it's
Yeah, that's the Home Style. It's a sweet product. I love it. 660 credit score, the lowest, 12 months reserves. So basically, when you come to closing, you put your 15% down of your acquisition and improvements. You're going to need 6 months of payments if you're a 680 or higher. If you're under 680 down to 660 minimum credit score, you will need 12 months. Plus, if you hold any additional properties, you will need 2 months of reserves on each one of those. But that's something we can talk. I don't expect you guys, no one wrote that down, so I expect you to ask me. Or I'll make sure you don't get
have
too
to be
busy.
owner occupied property to get the home style.
What was that?
You don't have to be owner occupied.
Yeah, you go up to 95% on a primary residence.
He said you have to be or occupied
To buy Fannie, and with the rehab feature, you mean basically take their REO? Is that what you're talking about? You're taking their REO off Fannie's REO asset manager? I don't know about that program. I'm sure they're out there. There's hundreds of programs, Sham, that, I mean, HUD's, I don't think HUD's got them. I know Fannie and Freddie, they're trying to liquidate some things and free up some things. But if you need me to look into it, I'll be more than happy to look into that for you.
The FHA program is solely for owner occupied people,
Yeah,
but Fannie Mae has a program just for investors.
exactly. Home style, and it's up to 85% of the acquisition plus rehab. So it's a pretty good product.
Do you have to buy from the Fannie?
No, you can buy anything you want out there on the Fannie or Fannie Mae Home Style. So even if it's a private sale, you can buy that. Here's what I've ran into when a private sale does occur and it's not MLS listed, is if they find that you have a sale that's not MLS listed, okay, it's not on the MLS, and it's a private deal, they don't really, lenders don't like that because it could be a non-arm's length transaction. There might be something going on there, especially if the comps don't support it. Like some of my commercial lenders, they won't allow me to lend at 80, unfortunately. And the reason why, and they don't like the small loan amounts, and people want to know why can't you get these small loan amounts. Typically, I like to be at 75,000 or less. I will go down to 50 or higher, but I stay away from 75,000 or less, I'm sorry, and 50 and 1,000 or higher on a case-by-case basis. The reason why is a foreclosure costs a lot of money. I mean, you're seeing some of these banks, it's 15, 20,000 by the time they get there. That's why they don't do them. A foreclosure is costing 15 to 20 grand. Some people, I talked to a real estate agent today, said, "Jerry, knocked on the door. They've been in that house rent-free for 10 years. The house got foreclosed on 10 years ago, and they're still in it because the bank didn't move their feet." So, I mean, these banks, they've gotten whooped, and they're not doing it anymore. They're not taking it, and actually, so probably the pension funds that took the whooping because they were mortgage-backed securities, but we won't get into that. So, any other questions? Good job, I think so.